Welcome back, investors, to Ticker Time News. I'm Adam, and today we're talking about the Nasdaq 100. Yes, the Nasdaq 100 is tech heavy, and tech has had a rough month of March. Luckily for us, it's April, and it sure would be nice to know what April has in store for the tech sector. Well, two chart patterns have appeared on the charts, and I'm going to dive into what those two chart patterns are, what they mean, whether they're negative or positive for the tech sector. So hang with me as we dive into this. But real quick, before we dive into the details that you came here to see, you can help out the channel and earn free money while doing it. First, earn $10 worth of Bitcoin by signing up for a BlockFi interest account and depositing $100. Plus, the added benefit to using BlockFi is that you will earn interest of up to 8.6% annually on your cryptocurrency. Second, earn 2 free stocks worth up to $1,850 by signing up to Webull and depositing $100. Click the links below to get started. Now, back to the video. So there are two chart patterns that have showed up on the chart. What are they? The first one is a double bottom. A double bottom looks like the letter W. They're pretty easy to find, but there are some criteria that they have to meet in order to be called a double bottom, not just the shape of a W. Number one, the twice touched low should be support, meaning this double bottom right here. You have the first downtrend and it reaches its bottom and you have a little rally. The second downtrend should not go any lower than the first one. If it does, that's not a double bottom. Okay? All right. Number two, the bottom should form within 2 to 4% of the previous low. Okay. This bottom right here is our previous low. So if we draw a line straight out, straight across, okay, and then we measure from here up to where the bottom is, it should be in the range of 2 to 4%. This one right here is 2.4%. So we're in the range, so we can check two things off the box. All right. Another indicator of a double bottom is that the first downtrend needs to be at least a 10 to 20% pullback. So from the very top of the previous rally, which would be up here, down to the bottom, the low of the first part of the W, that drop needs to be between 10 and 20%. This drop right here, it was 13.5%. So we just checked off 3 boxes. So we know this was a double bottom. The first fall fell between 10 to 20%. It fell 13.5. The second bottom of the W here came within 2 to 4% of the low of this side, the very low. And yes, it did. It's 2.4%. And it's in the shape of a W. Check, check, check. All 3 boxes are checked off. This is a classic double bottom. Okay, that was back in September and October of last year. What about right now, the month of March? Okay, so starting on February the 16th, that's when the market hit its high right here, February the 16th. Then we had a downtrend. Now, did this downtrend go at least 10 to 20%? Yes, it did. It went 11.9%. Check 1 in the box. Next, the second pullback, did it come within 2 to 4% of the previous low? Yes, it did. 3.3% to the previous low. Check off box number 2. Now to check off box number 3, is it in the shape of a W? Yes, it is. All 3 boxes checked off. This is a classic double bottom. Now, what does a double bottom mean? Is it negative? Is it positive? Well, right here, listen to this. The double bottom pattern always follows a major or minor downtrend. Is the W formed because of a downtrend? Yes, right here is our downtrend. This is our downtrend. Yes. Okay, let's keep reading. All right. Downtrend in a particular security and signals the reversal and the beginning of a potential uptrend. So, what does the double bottom mean? The double bottom means it's a signal of a reversal and the beginning of a potential uptrend. Okay, that's key to know for the second chart pattern that's on the chart. Let's scroll in here. Well, first, let me back out and I want to show you something. Do you see the brown line running along the sticks? That brown line. That brown line that you see running across the screen with the sticks, with the candlesticks, that is the 100-day moving average. Now, there are 3 blue circles, one over here, one over here, and one over here. Those 3 blue circles, they show that in each one of those circles, when the stock fell and hit the 100-day moving average, the stock bounced off of that 100-day moving average into a rally. If you look at this blue circle here, when it bounced off of the brown line, okay, and started the rally lasted from April of 2020. The rally lasted all the way till the very 1st of September of 2020. And then we had a double bottom. And then after that double bottom, look right here. On the way up, on the complete right side of the W, on the way up right here, we had a bounce, okay? Because it's just not all green days. There's green days and red days. More green days, then you're going up. So right here in this blue circle, it started to fall, but it bounced off of the 100-day moving average. Coming out of a double bottom, and then we had a rally from the beginning of November 2020 all the way to the middle of February 2021. Okay, keep that in mind. Let's scroll in and look at this a little closer. In this green box right here, we had a green candle coming up, and then we had a red one fall, and then guess what? It bounced off the 100-day moving average. So we're coming out of a double bottom, and then we have a back test and a bounce off the 100-day moving average. Those 2 signs together are very positive. Back in September and October of 2020, we had the exact same setup. We had a double bottom, we had a back test and bounce off the 100-day moving average, and then we rallied from November to February, November 2020 to February 2021. Is that what we're going to see now? It's very possible. But you also have to consider other market conditions as well. Like, what's the Fed doing? What are interest rates doing? What's the economy doing? Jobless rates, everything. You have to look at the whole economy together. Now, I believe spring is going to be a rough time period. Okay. It might be a lot of consolidation, but I believe once we get to summer, we're going to kick into gear. It's just like having an old car that's been sitting around for a while. You go to start it up, the engine might not turn over as fast as it should. It might not start on the first time. You might have to try it a few times to get it going. And then, the brakes might be squealy because they've been sitting for a while. You get it on the road, it might jerk around a little bit. The steering might not be perfectly aligned because the car has been sitting for a few months. Well, think of our economy as that old car that's been sitting around for a few months, and it's got to get started again. And it's going to take a couple of months. It's going to take a couple of quarters. First quarter's over with. Now we're into the second quarter. It's going to take a couple of quarters for the economy to get firing on all 8 cylinders again. So that's why I believe this is a positive sign on the chart, yes, but we have to take the whole economy into account. This could be a rally that's forming, yes, but it could be a rally consolidation, not a full court press and a rally for several months. Both chart patterns are positive, yes. Okay, I hope you found a ton of value in this video. I enjoyed going over it with you. Do me a favor, smash that like button, click subscribe, and join our family of investors. We're on a mission to help as many retail investors as possible this year. All right. Thank you for watching, and I'll see you in the next video.